All right, let's get started. Thank you everyone for your patience. Thank you for your attendance. This is the first time I've ever done this presentation, and it's definitely different, but I really do hope that it helps you think about your trading and how to get from where you are now to where you'd like to be more efficiently. And as always, everyone here at Market Gauge is here to help you do that, whether it's us helping you get there or it's us helping you find another way to get there. We are definitely here to help. Now, I am going to ask for some participation in this, especially right up in the beginning, because as I say with a lot of my presentations, this is for you, and the more you participate, the more you'll get out of it, and the more I'll be able to give and have you get out of it as well. All right, so the challenge we all face here, and you're here, I assume, because you want to build your wealth with the stock market. That's what I said I was going to help you focus on and do in this presentation, so I'm going to assume that's why you're here. But let's start with some of the challenges that we all face doing that. Right, there are an overwhelming number of choices of ways that you're being told you can do exactly that. Either make more income, build your wealth, get rich quick, you name it. And a lot of them will work. Most of them will not, for sure. This is a treacherous industry for sure. And in order to figure that out, and in order to actually achieve it, it can take you years to build the wealth that you need to do this the right way. And even if you spend all your time doing it the right way, there's still financial risk. It's always emotionally difficult. If anybody has been trading for any more than a couple of months, and those couple of months have had a couple of ups and downs in the market, you know that this is an emotionally difficult task. But the flip side of emotionally difficult is it's also emotionally rewarding for most people. If you're not careful, this can be really time consuming. It doesn't have to be time consuming, but it is time consuming if you're not careful. And unfortunately, the list could go on, but I can just sum it up with there's no guarantees it's going to work. Now, maybe that's part of the excitement, but unfortunately, that's just the reality. Now, I don't mean to be a downer. In fact, there's a lot of good reasons to do this. Like, why should you do this if everything's as bad as I probably just made it sound? Well, the flip side is I believe and have believed for, I would say, my entire memorable life, like since middle school, just about, I believe that the stock market was a way to reach financial freedom, have a great retirement. Of course, in middle school and high school, not worried about financial freedom or retirement. I'm worried about the fancy Porsche or something. But now it's the same thing, right? We want to be financially free, self-sufficient. We want to be able to provide for our family and future generations, most likely. And all this, if that's not what gives you peace of mind, certainly knowing that you can do that can lead to peace of mind. A lot of people tell us that they like being involved with the market because it helps them with philanthropy, helping other people. I hope, and sometimes I feel a little bit woo-woo when I say this, but I do honestly believe it. I hope it's enjoyable, because if you don't enjoy doing this, I got bad news for you. It's not gonna work, right? You really do need to enjoy it. But what I'm going to talk about in this presentation is how can you find the right way to enjoy it? How can you find the right way to make this work? Now, I'm going to ask you a quick question. When I talk to people one-on-one, I ask this or a very similar question, and I'd like you to put this in the questions box. Can you describe your ideal investment style? Now, what I mean by that is it doesn't necessarily have to be your ideal trade. which you may have heard me asking in another webinar. But how would you describe your ideal approach to investing? Let me give you an example. That example might be, I want to trade stocks for long swings. I want to trade options for quick gains. I like to trade ETFs, so I don't have to worry about earnings or specific company risks, or because I like to trade a variety of different assets, or I like to trade futures. Put it in the questions box. How would you describe your ideal investment style? And just include in that some kind of a duration, some kind of instrument that you'd like it to include. Maybe how much time you would like to be spending in a given week. Let's call it a week. So if you only want to spend a couple hours a month, you could put like 1 hour a week. Or if you like to sit and watch the market for several hours a day, then it's going to be, I don't know, 5, 10 hours a week, 20 hours a week. If you're really focused on it, maybe it's 40 hours a week. And you're doing this, I'm the only one who's going to see it. I'm not even going to be able to read all the answers in detail, most likely. So you're doing this as much for me as it is for you. So I read Trend is Your Friend as I scanned down it, and I thought I read so I can hang out with my friend. But that's kind of like hanging out with your friend, right? If you're trading the trends. All right, so I'm just going to read a few. Oh yeah, let me know if you're doing this. No, I don't want to pollute the question. What I really want you to think about before I go into the description of potential shortcuts is, how do you want to trade? What do you want to trade? And there's a reason for it. The reason I want you to think about this is because we're going to talk about it. And so I just want you to I want you to be thinking about what you want to do before I start talking about what I do or what other people do or what you can do. Because I really believe that if you are thinking about what you want to achieve as you're watching our webinars, this one in particular, then you'll be thinking, how can this help me? I don't want you to be thinking in terms of, how am I going to tell you what to do that doesn't really work with your style? I want you to be thinking, how is Jeff talking to me about what I want to do? All right, that's why I'm asking you to think about this. That's why I'm giving you some extra time, because I'm pretty sure there'll be people out there saying, I don't need to answer this. What does he need to know for? It's not for me. It's not for me. So just as an example, someone here is writing that they want to, or they like to trade or sell options for spreads for income, right? That's a lot different than the next person who's saying 401k long-term trend based on 50 and 200-day moving average phases. Okay, so I want to speak to both of you, and I want you to be thinking how what I'm saying to you is going to relate to what you're doing. So that's why we're doing this. That's why if it seems like I'm stalling for time, I am, not for me, but for you. This isn't a long presentation, so don't worry. Although I know some of the names in here are not going to believe me when I say this, but don't worry, we're not going to be going on until 10 o'clock because I'm talking too long right now. All right, so I want you to be thinking about you. What do you want? All right. So this is a similar question, but we're going to preface it by this quote by Benjamin Graham, which I actually thought, in doing my research, I should have double checked this now that I'm thinking about it. I wouldn't have expected Benjamin Graham to be saying this, Benjamin Graham being the, whatever you call it, godfather, the father of like modern financial or fundamental analysis. He says, an investor's chief problem and even his worst enemy is likely to be himself. How many people would agree with that? Just put yes or no. The investor's chief problem and even his worst enemy is likely to be himself. Yes or no? Everybody's free to have their own opinion. I'm just curious to see what the blend is going to be. And I don't mind if you spell yes with 4 S's either. Okay, so I just thought of something for the outside. Nobody has said no. Oh, we got one no. We got one no. Is that no like the chief problem isn't likely to be himself? I was just going to say we haven't had one no yet. Now, look, you're entitled. Actually, that would be great to hear that is true. I don't think it has to be, but I would agree, and I'm glad that a lot of you see the issue here because, and a lot of you are experienced. I know that because I know a lot of the names. It's the experienced traders that realize this. This is a huge part of trading. So what we're going to talk about is this question: which path suits you? Automated trading systems, where you follow a rules-based system; discretionary, where you're using your instincts and your knowledge, or maybe you're just best delegating to an asset manager that you trust. Look, this game isn't for everybody. Like I said, if you don't like it, then this probably isn't something that you should do. But that said, the stock market is absolutely, as I've already said, one of the greatest wealth mechanisms I think ever invented. So even if you want to delegate it to somebody else, you'd still be wise to understand how it works, what you can and can't expect, and also understand risk management. I'm going to talk about risk management, even if you've got someone else doing it. All right. So there's automated systems, and when I say automated systems, for those of you who are new to Market Gauge, I'm talking about a system that is telling you exactly where to get into and where to get out of a trade, so you don't have to do any of the analysis, versus a discretionary, where you're going to do all of the analysis. All right. Now, we are an advocate of all of the above. Okay. So while we definitely have a bias towards a systematic approach, meaning that if a system works for you, probably the best way to go. If you enjoy doing it with a discretionary approach, then we would advocate being very systematic in your approach to it. All right. Now, shortcut number one, I would say, is from Warren Buffett, and that is, he says it's good to learn from your mistakes. It's better to learn from others' mistakes. So I'm gonna twist that a little bit and say you could learn from other people's success as well. You don't need to reinvent the wheel here. In fact, I'm going to emphasize in this presentation that you don't try and reinvent the wheel. We do believe that it's really important that you embrace and adopt the system that is yours. You want to make whatever you're doing yours. That's really important. Just blindly following somebody else's approach without any understanding of what's going on is not advised. And that's coming from somebody who is going to tell you, we have a way for you to approach the market where you don't have to do anything but simply follow exactly the signals we give out. We're giving you the signals that you don't have to do anything but blindly follow. But at the same time, we are very much an advocate for understanding where we're getting these signals from, why we're buying it. What's our risk management? So that you understand what you're doing. So even if you're not doing the analysis, you should understand what you're doing and what you're trading. You'll be much more successful. So absolutely, you want to learn from other people's mistakes, but at the same time, you can also learn from other people's successes. And the theme here is also that you really should embrace education. All right, whether you get it from us, whether you get it from somebody else, book, I don't really care where it is, where it's from, as long as it's good, it's consistent, and you're pulling it together in a way that we're going to talk about in this presentation. All right, so before I jump into different ways to approach the market, just want to make sure that anybody is here at a Market Gauge presentation for the first time, that you understand a little bit about where I'm coming from. I'm the only one doing the presentation here, but I'm certainly not the only one at Market Gauge. I've got two partners, Keith and Michelle, who you see right under my picture here. You may have seen Mish on any number of major media outlets. She's out on them all the time, being asked her opinion and for trading ideas. The three of us have all been floor traders back in the day, 70s, 80s. I joined in the 90s. Keith and I joined Keith in the 90s on the floor of the Commodities Exchange. And then in the mid to late 90s, Keith and I managed money for Millennium Partners, which is still to this day one of the largest and most successful quant-based hedge funds, certainly in the country, maybe in the world. And Keith and Michelle currently manage money at Market Gauge Asset Management. And we're a web-based company, but we don't want to be a faceless web-based company. Yes, you can get us at info@marketgauge.com, but you can also get us live. We've got live chat during the day, and live chat converts to live chat offline at night. Leave us a message there. That's the quickest way to get us. If you've got any questions about your account, give Mary a call in the office at 888-241-3060. The number's on the bottom of every page. If you want a free strategy call, call Rob at 407-770-7637. That's his cell phone, so don't call him at midnight Eastern time. You can schedule a call at marketgauge.com/call. You'll also see, as you become more familiar with us, you can schedule a call with me as well. So we want to be available for you. So please take advantage of it. All right, let's get into the details. So my objective here for you is actually to make things simpler. It's to cut away the complexity to get to the path of thinking efficiently about how you can best approach the markets to get to where you want to be. Without making that sound too philosophical, I believe that there's three things, and these might not be the three things that, certainly I can tell you these are not the three things that a beginner trader is thinking. All right. So for me, I know that I've got people on this call who have been trading for decades, and for names I don't know or don't see, you might be brand new. So if this doesn't sound like the right list because you're brand new, please bear with me. There's three things you need to be successful in trading. You need risk management. Number one, I mean, if you don't have good risk management, your time in this game is limited. So I could put one thing on this list. It would be risk management. Now, the second thing you need, and I'm not going to say this is in order of priority, is discipline. And discipline is often has a negative connotation. In this case, it is not that. Discipline, as I'm using it here, is just the ability to do what you should do when you should do it. So and that's a tall order when your money and in some cases your ego or your pride is on the line. So discipline is absolutely critical. And the last thing is you really are better off if you have a proven trading strategy that you can execute consistently. Now, the truth is, if you have a strategy that really doesn't have historical results and it's not that easy to execute and you're not very good at doing it consistently, but you've got good discipline and you've got great risk management, you can probably make it work. But you're going to see in more slides that I think this should be enjoyable and it should be less stressful. If you want it to be enjoyable and less stressful, more reliable, more predictable, then you're going to want to be having a trading strategy that you can execute consistently and that you know is proven. And when I say proven, I just mean that you can see or demonstrate historical results. All right, so we'll talk about what proven means. All right, now, so again, I don't want to turn this into a Tony Robbins course or a total motivational session, but I do focus on things like that, and from that angle, if you want to be successful in trading, you want to strip things down to what you really need. This is what you need. All right, risk management, discipline, and a strategy you can execute consistently that you can see the results over time. Right, so that should be a primary goal. So what does it really take to do those things, to have those three things? Well, if you want to increase the odds of the success of doing that, you have to make sure that your strategy fits your personality and your lifestyle. Right? There's no, it's not a coincidence that I honed in on one of the answers earlier that was about selling premium with option spreads for income. Okay, now kudos to the person who wrote that because it was really specific for income. All right, now if that's what you want to do, then that needs to fit with your lifestyle. Now, my guess is that if you're selling option spreads for income, you have to be pretty in tune with the market on at least a weekly basis. All right, that's not something you just put the trade on and come back in 3 or 4 weeks. All right, which you could do if you were looking for long-term investments or long-term swing trades. You may not have to look at the market for weeks. You may not have to spend much time doing any kind of analysis if you're a long-term swing trader of ETFs, or you're just following a system that doesn't trade very often and doesn't require you to do any analysis. You can go spend you don't have to spend much time at all looking at the machines. All right. Now, the other thing about your personality is, I talk to a lot of people who don't feel very comfortable being in the market for very long. Right? They worry when their money's in the market. Right? That's a personality trait. I'm not saying it's good or it's bad, but if you want to be in and out quickly, then make sure you are trading a system that's in and out quickly. If you don't want to have or experience a drawdown of 20%, then there are some of our strategies that aren't going to work for you. All right? Because your personality is one where you don't feel comfortable with that kind of exposure to the market that might draw down 20%. So you need to understand that it's not a good thing or a bad thing in terms of judgment of your personality. But that's why I started the presentation by saying, what do you really want for an investment style? What's your approach? All right, make sure it fits your personality and your lifestyle. I have a friend who doesn't want to hold any positions overnight, just doesn't want to do it. He wants to be done and wants a day trade only. All right, that guy should not be trusting somebody else's system that's going to be in positions for weeks. He's just never going to follow it. All right, I've said this. because I knew it was coming, you have to keep it simple. All right. The some of the best investors keep it simple. It needs to be simple for several reasons. One, if you want to be able to execute consistently, it needs to be simple. If you want to be able to identify your trades quickly and easily, it needs to be simple. All right. Keep it simple. Third is focus. Now I could go all different directions with focus, but I'm gonna pick this one because this to me is one of the shortcuts for this presentation. A shortcut for getting from where you are right now to where you want to be, figuring out the market, is to spend less time trying new things. Focus. All right. Don't jump from one great idea to another great idea to another great idea, because when you do that, you never finish figuring out if that first great idea was great or not. And you don't learn as much from that first one to take to the second one. And as a result, you wind up going through one thing after the next thing after the next thing, and you don't get any real benefit out of any of them. All right, now maybe that's a little bit of an exaggeration, but I would not just venture to guess. I would say definitively that if you don't take a strategy or a group of related strategies and focus on that for at least 6 months, then you're not giving it a chance. All right, it takes longer than that. Now, that doesn't mean you can't check something out for a couple days and decide whether or not you're going to use it. But your decision, if you want to increase the odds of your success, should be, I'm going to focus on this for 6 months. So one of the examples I use to explain this concept to people when I talk to them privately is I ask the question, so if you were to look back, if you've been trading for more than a couple of years, and so you can look back and say a couple of years ago and ask yourself, in the last couple of years, have there been numerous opportunities where I could have done well in the market? I mean, how many of you would say, if we just went back 2 years ago, if you could look back 2 years ago and say to yourself with confidence that if I really had things nailed down 2 years ago, there would have been some really good opportunities that I could have caught. Is that a fair statement? Do people agree with that? 2 years ago, you were an expert at something, and by being an expert, there were plenty of opportunities to take advantage of that. And I'm just saying 2 years, right? Great, yeah. So I'm glad several of you are agreeing with me. And the reason that I'm saying that is because in the next 2 years, there are going to be a lot of great opportunities. Now, I don't know what they are, but I know this, that if you're good at something in the market, and this is what's great about the market, if you're good at something at the market, there are going to be opportunities. And that's how you're going to make your money, by being prepared and being there when the opportunity exists. If you're jumping from thing to thing to thing to thing, you're not necessarily prepared. You might get lucky and capture them, but long term, you're much better off being good at something and then capturing the opportunity. Now, you could be good at a bunch of different things, and actually, while this is beyond the scope of this presentation, once you get good at one thing, adding another thing to your expertise is a lot easier. So my emphasis on focus is spend the next 6 months. Now, many of you won't have to spend the next 6 months, but you'll know what I mean in your own trading. Spend the time to really nail this down for 6 months, and the rewards will be there to pay going forward. If you're always thinking, I've got to do this now. I had this conversation recently with someone who, and this I think is where this whole idea of trying to explain this crystallized. He said, I've missed the move. Like I've missed it. And you know what his solution to, or his proposed solution to having missed the move of 2023 was? It was to trade bigger, to make up for the time that he had lost. And while I completely understand it, he still didn't have an expertise. He still wasn't sure what he should do, but he was feeling like he should trade bigger, not smaller, not spend more time trying to figure it out. He was thinking, how am I going to get caught up? And when he said that, the light bulb went off in my head, like, wow, I never thought about it that way, because I wouldn't, but I understand it. So please don't think that way. Don't think that because you missed it, you have to make it up with this heroic effort now. It's the opposite. There's plenty of opportunities coming down the road. You're more likely to get hurt trying to do it quickly than you are to make up for what you've missed. All right, so I'm going on too long, but focus, that's what I mean by focus. All right, you will thank me if you focus. In fact, another story from talking to an individual who was very unhappy with the way one of our strategies was going. And I asked her to just focus on it for, it wasn't even 6 months. I think it was 3 months. And she called me up after 3 months, and I was thinking, man, this is going to probably be a rough conversation. I know she wasn't happy before. And at the beginning of the conversation was, I forget the words exactly, but she's like, Jeff, I learned something. And what she learned was that doing a strategy wasn't for her. And so while her experience with trading a strategy was not a good one from a financial point of view, she was thanking me. And the reason she was thanking me, it made total sense, because what I have here on this page, your shortcut, find your best strategy. She had spent way too much time trying to make this automated strategy work. And what she learned was that her discretionary trading was really what she loved to do. And that's what she was best at doing. And that's what she should be doing. She shouldn't be spending her time trying to do this strategy, because she's spending more time trying to not follow the rules that she didn't like than she was following the rules. It just didn't work. So that's a little bit of an extreme example. But again, I asked you in the beginning of this presentation, what do you want to do? If you weren't really sure, or you weren't really clear now that you know why I asked you to do that, this is what you really, the shortcut number one is find your best strategy that meets your or matches your personality. And so again, what do I mean by your personality, your lifestyle? Think about the time you're going to be in trades. Does that agree with how you want to trade if everything were to work? Your risk and reward expectations. All right. So if you're selling spreads, if you don't trade options, you don't have to know the details to know this. But if you're selling option spreads for income, there is a finite amount of money you are going to make on that trade. It's just, that's the way it works. Now your percentage of being right is probably statistically a lot higher than what I'm going to suggest next, but there's a finite amount of money you can make on that trade. This is why for the longest time I didn't like selling spreads, because what I like to do is put on a position and have it just keep going and going and going and going. Well, my favorite positions are the ones that I've only got a quarter of whatever my original position is, and I've held it for what I thought would be maybe weeks to months, and now I've had it for years, and it's just this green spot on my screen that I just can't believe that I've made that much money off of that few shares. To me, I leave those on my screen because they're a reminder to me of how much fun swing trading can be. That is totally the 180%, 180 degree opposite of selling option spreads, right? So I need to understand when I sell an option spread that I'm doing this for this side of my personality now, because now I like it. Now ironically, I'm really enjoying selling option spreads on 0 DTE options. All right. Yeah, this is the same guy who just said that my favorite trade is to put on a swing trade thinking it'll last weeks or months and still having it years later because it just keeps going. But I compartmentalize those. My 0 DTE is my fun for the day. Like that's my hit. The longer term swing trades, that's my that's how I'd like to define my trading. All right, those are two totally different things, and I have the luxury, I consider it a luxury, to be able to do the thing I love to do every day, which is stuff like this, working with you, have my own business, and trade whatever I want. So I have the luxury of being able to sit in front of the screen all day. If you don't, then your lifestyle doesn't allow you to do the same things. All right, so risk reward, big, that I was just describing also. Drawdowns, profit expectations. I talk to people who are just fine with their account going down 50%. That would drive me nuts. All right, so I need to make sure, you need to make sure that if you don't want volatility in your account, that your strategies aren't going to create that volatility. Because I believe that anybody who wants to master this game can. But 90% of traders, or whatever the statistics are, fail. The reason they fail isn't, 90% don't fail, they give up, they quit. And nothing against them, I would quit too if I lost too much money. But there's a solution to not losing too much money if you really want to be here. All right? Don't go down a road if you don't understand what the drawdowns are. And percentage wins and losses is not a way to judge the success of a system, but it is a way to judge whether or not that system is going to work for you. All right? If you have a system that has really high percentage wins, it's going to have a very particular characteristic to it, most likely. All right? You can have a system that doesn't win very often, that makes a lot more money than systems that win all the time. Make sure you understand the difference. We talked about swing trading, day trading, long, short. Some people love to go short. Some people just can't short very well. I definitely have a bias to being long. I trade much better on the long side. Easy to execute, we talked about that. Enjoyable, I've been talking about that the whole time. All right, so your best strategy needs to fit your personality, execute consistently, and be enjoyable. All right, remember that number one I had on risk management? So we have systems. I'm going to show you some of them in just a minute. And these systems are systems where we tell you exactly where to get in and exactly where to get out. And they all have an edge of some sort. Many of you have seen my webinars on them, so don't worry. You're not going to get a webinar on each one of these right now. We'd be here all night. And I'm always explaining in these webinars what the edge is, why we have these systems, because when we build a system, we start with what advantage do we have over the market with this particular approach? It's not how do we just test this indicator and see how many different iterations we can run through to find something that works. It's not how we do it. So it would be easy to think that, let's take our sectors, for example, as a start. It would be easy to think that the reason that the sectors is so successful is because there's an edge there, which I'll explain in an upcoming slide, that has to do with leading sectors always outperform the worst sectors. And while there is that edge there, and that is a reason to be doing it, we also have a system that trades the SPYs or the Qs that we call alpha, and it rotates between SPYs and TLTs, and it only gets in when the trend is just right. And using double SPY doubles and Q doubles over since 2007 or 8, I think, it's up over 7,000%. The sectors are up 1,200% since 2008, I think. Profit Navigator trades the SPYs with using market internals, and in the last 4 years, I think it's up 450%. NASDAQ All-Stars ranks the top 100, the NASDAQ 100 stocks, and then trades the top 5, and based on TSI. So it's got that edge, and it's up 2,200%. And you can see how it goes all the way down to crypto, where crypto, we're just trading the two top large cap crypto coins, and that's up 97,000%. 97,000, that's not a typo. But that's what crypto does. You know, it also has a lot of volatility, but we'll point that out. But the reason I have all these on this slide under great risk management is that, you know, unless you've talked to me personally, you probably haven't heard me say this. The secret to all these isn't the entry, it isn't the edge, it's our risk management. And the risk management that we use in all of these systems is remarkably similar. All right, so when I say that your shortcut to success is great risk management, here's your proof. Every one of these systems has a very similar philosophical and literal approach to risk management. Okay, I couldn't think of a better way to prove that than to let you just have these numbers sink in. Now, they all started in different times, like Profit Navigator is only 4 years old, where Sectors goes back to 2008. So the percentage gains aren't really fair to compare. But my point is, you know, just finding any system that has percentage gains like this, regardless of your time frame, is pretty impressive. And so I hope I can impress upon you that it's risk management that's really making that all possible. All right, so which path suits you? Automated systems or discretionary? Or a combination of both? I'm going to keep it simple. Automated systems, as I said before, following the instructions. So from our perspective, an automated system is just buy SMHs on the open tomorrow. That's all you got to know, right? And then once you do that, we'll tell you where your stop is. We'll tell you where your target is. Follow that, and that's all you got to do. Now, as I said earlier, when we present these or you talk to Rob about them, we want you to understand, or you participate in them. We have monthly webinars or monthly coaching sessions so that you'll understand what it is you're actually doing. You don't have to, but we would really recommend that you do. But the point is, you don't have to spend years learning how to read the markets. You don't have to spend hours analyzing the markets. I love spending years learning about the markets. I love spending hours analyzing the markets. So for me, the automated system is a shortcut to being able to trade a whole new strategy, not have to do any work. But my personality is such that I also really like the discretionary. I really like to think it through myself. And in some ways that can get myself in trouble with the automated system, because sometimes I will, and very often times I will try and beat it. Like, that's just my personality. Now, the benefit of the automated trading system is also that it's got a tested track record. So before you even get involved with it, you can see how it's done in the past. And that's really important. Even if it's back tested, it's really important, because that can be used for an expectation going forward. So you can measure whether or not it seems to be on track, so that you can anticipate what kind of drawdowns there might be. Because if you're trading in a discretionary way and you think you've got this all figured out, because you've got this new magic indicator, and we've got a couple of those, and you go to start trading it, you don't really know how well it's going to work when you're using it. And we haven't told you that 30% of the time or 90% of the time it's going to work, because we can't, because it's discretionary, right? So discretionary, you have to be confident and have the discipline and the strategy and system to execute all on your own. Right now, again, I like doing that. I know a lot of people like doing that. I told you a story of a customer who likes it so much that as much as she wanted to do the strategy, the systems, she couldn't, because she didn't want to follow it. She couldn't trust a machine, right? So if you want to stop wasting time on something that's never going to work, figure out what you like to do and what you want to do, and again, focus on it. All right. If you like to read charts, evaluate news and financial reports, discretionary is probably the way for you, right? If you personally want to determine every entry and exit, now that may sound, to some of you, that may sound like torture, but to somebody else, it sounds like, of course, it's the only way I want to do it. If I didn't want to do that, I just give it to somebody else to manage. Right? Now, I know for a lot of you, this probably sounds pretty, of course, but if it does, then I'm willing to guess that you've probably already found a strategy. You've probably already found your lane in terms of discretionary, and you're just trying to refine it, and that would be great. All right. And if you're just trying to refine it, I still would say the same thing about the 6 months. Give yourself 6 months to make it better. Stay on a path. Don't jump from thing to thing to thing. All right. So let's talk about some of the systems. I don't have time to go over every single system that we have, but what I have done is pulled a couple of systems, giving you a good idea of generally what they do, so that we can have this discussion, or you can have this discussion in your head of, is this the way I'd like to trade? If it is, you can give us a call. I don't have a big sales pitch at the end of this, so you don't have to worry about that. I want you to absorb the possibilities, think about whether this works for your personality, and relate that to what you're doing. And if we can help you get to that next level, I've already told you, you can talk to us. You can give Rob a call, you can give me a call, give Mary a call, send us an email to learn more. So let's dive into it. We've got a few more minutes. So ETF Sector Plus. What I want to share with you about ETF Sector Plus is that you're trading ETFs and you're focused on major sectors. What we did is we broke the market into about 20 different ETFs that represent every sector. The reason for that is we wanted to cover everywhere money would run to during different economic cycles. We'd have an ETF that would be covering it. Now, the edge here is that there's on average 68 percentage point difference between the leading sector and the lagging sector, the worst sector. So if you're in the strongest sectors, by definition, you are going to outperform the market, because it's got the best sectors and the worst sectors in it. Now, there's no way to know exactly when the best sectors are going to be the best sectors and for how long, but we have a system that takes advantage of a 100-year-old approach or proven method for the market, which is, if you rank the relative strength performance of instruments, rank them, and then trade the strongest of the group, that segment of the market will outperform the weakest segment of the market, whether it's sectors or stocks. We did it on countries. We've done it on large cap stocks. We've done it on small cap stocks. We've done it on global macro assets. So this concept worked. The research that we read before we did this went back to the 1920s, both in terms of individual stocks and in terms of industry groups. All right, so we didn't make this up. We just made it better. We just made it easier. We just adapted it to ETFs, and we made it available to you. So this concept has been around literally in research since the 1920s. Now, the other great part about trading ETF sectors, there's no company risk, because you have a sector and there's 20 to 50 different ETFs in there. If one company comes out with a bad earnings report, it may rock the boat a little bit, but you're not going to get wiped out like you would if you owned that particular company. The other nice part about sectors is you get to ride macro trends, macro in terms of the market and economic. And another one that is, I think, underappreciated is that when you understand sector rotation, and this is exactly what we're trading and finding and tracking, you really have a good sense of how strong the market is. All right. There are certain sectors that just don't do a very good job at leading bull markets. So, a good example of sectors that do a good job at leading bull markets is what? Everybody, I think, is going to say, well, I'm sure a lot of people would agree that when we have a market that the semiconductors are leading, that's a bull market that's going to be fun. All right. Everybody, I shouldn't use that term. It's really popular to say that we need the financials to lead this market, and then it'll be a good bull market. You know what? I don't know. I don't really remember the markets that the financials were the leading industry group. I remember the markets where the technology was the leading group. But do we want the financials leading? Yeah. Do we want the utilities leading? No. Do we want gold leading? No, that's not a great way to lead a great bull market. But with ETF Sector Plus, if gold is leading, we'll be in it, which means it could be a crappy market, but gold is doing great as a result, but we'll be in gold, right? So that's the benefit of being in ETF Sector Plus. And we've got a couple of different flavors of it. One that's conservative, no leverage at all. One that's moderate, we have some leverage. This is what I'm showing you. And one that's aggressive that has a lot of leverage. As a result, it has a lot of volatility. I don't recommend it. We have customers that love it. That's what they want to do. They like the action. I don't recommend it because you could go down, you could have a 40% drawdown. And for me, that isn't what I want. There's one time that I'd like to get a hold of the aggressive ETF sectors, and that's when we've just gone through a bear market, and I believe that we're turning up. And that's when I want to be involved with the aggressive sectors, because the leading industry groups from the bottom of a bull market are some of the most dynamic. And on the super leveraged side, those are going to be the first ones to turn and the biggest moves higher. So it makes a lot of sense to me. Once we're well underway in a bull market, I got to be pretty confident. So stick with the moderate. That's what you can see here. This is the one I quoted earlier that's up about 1,270% or something. And you can see the red line here is the SPYs. Doesn't really look all that exciting since 2008. And the sectors, it's had some down moves, but the max drawdown on the sectors here is less than the SPYs. So the SPYs max drawdown is around 35% or something, and the moderate is slightly less than that. So it does have some drawdowns. It has some periods where it looks like it's flat, but then it goes through these periods where it just rockets. All right, so it's a great way. It is my favorite. ETF sectors is my favorite system to recommend to somebody who's never traded a system before, wants to be a part of automated trading with the least exposure to company risk or like risks out of left field, and really get a good sense of what the market's doing. So you can ride a train like this, get insight into the market, make you sound like a pro talking about sector rotation, and really understand how the market works. That's ETF sectors. So let's go to the total other end of the spectrum here and talk about small cap stocks. We say small mid cap because in this particular model, we have both small and mid cap. That makes it for a really exciting group of stocks. We trade the top 7. So we rank, every month we determine a new list, or a list, I should say, of 50 stocks that have great earnings ratings from Zacks. And those earning ratings are skewed towards earnings estimate revisions and estimate numbers. It does have a factor of the earnings growth as well. So one of the factors we look for is the Zacks rating, which is a 1 or a 2, which is a volatile rating, but we went to the experts on earnings to get that input. So we look at the Zacks 1 and 2, and then we look at 3 to 5 year history. There's a ton of different metrics you could look at in earnings, but what we wanted to do, and it worked, was take the small cap, mid cap universe, which would be kind of volatile, could be kind of risky, and try to make it more stable by imposing some rules that this can't just be a wing and a prayer small cap stock. This thing has to actually have some earnings behind it. And then we put our momentum trend strength indicator on it that we use on sectors, we use on NASDAQ, we use on large cap leaders to determine what stocks have great strong trends. And we're going to be, again, that's what we use to rank them and be in the strongest relative strength rank. And we do it with 7 stocks. The reason we use 7 in this model is because we built this model to be used by professionals and RIAs, and they needed more stocks so they're not too concentrated. So the benefit of this, as I said, exciting companies can be fast growing companies that can be strong trends. It's a little more volatile. The other nice part or interesting part about this particular model is we're using this model to introduce the idea of a combination approach, which means we've got this thing here called Idealab. And so Idealab is, I should not have pointed to it. Idealab is a section of the membership area where we provide additional information and additional trading ideas that aren't automated. So with small caps, just like sectors, we tell you exactly where to get in, exactly where to get out. You have a model portfolio. You could not know anything about stocks and just follow the buy and sell recommendations. Of course, I'm going to say it again. We don't want you to do that. We want you to understand what we're doing, but we don't want you to have to go to school or spend years learning how to trade stocks to do this. So somewhere in between, like, hey, let's understand what you're doing. Or if you want to be discretionary, and one of the reasons I really like this, and we just started Idealab, is because these are exciting stocks. We're going to talk about earnings information in there. I love doing that, even though most of what you'll hear from me is technical. And small mid cap, as I said, I believe that, it's not fair. If you're in the small cap index and you do really well as a stock, you move up to the mid cap. Now you're not in the small caps anymore. And then you do well, and now you're up to the large cap. So what does that leave small caps with? The poor index is always losing its best stocks. I don't really, the index itself, unfortunately, is not, doesn't look as good as the rest of them. And honestly, in this particular model is our best performing model over the last 5 years. And you'll see why in a second. The thing just cranks out big numbers every year. And it's because these are the exciting companies. And I believe also because we've layered in earnings. All right. So if you're considering a model, but you really like discretionary, you don't mind a little volatility, and maybe the fundamental side of this is interesting, then small mid cap earnings growth is for you because of Idealab and the nature of the stocks. and you can't argue with the performance. I don't have the year-by-year performance here. That's something Rob could get for you, but you can kind of see it. I'll point out that this is 2022. So in the beginning of 2022, they took a hit like the market did, and then they took off. And you know why they took off? They took off because the market didn't want large cap tech stocks. They thought large cap tech stocks have been leading the way. Interest rates are going up. We got to dump these things. They ran into the stocks that were making money that were small cap. Small cap didn't have as much exposure to interest rates according to the market for the beginning of 2022. It caught up to the small caps, but small caps were actually up on the year. Our small caps as an index has been horrible. As you can see, you know, from here, 2022 was bad news. It never really had a great run after 2020. 2021 was terrible, just flat. But for ours, 2021 was huge. We had a huge run and then it kind of flattened out. We had a huge run in 2020, a big run in 2019. So, you know, I wish I had posted the year by year results, but like I said, you can see it. It's been a great performer, and it's got the discretionary bent to it. Now, I wanted to also, we went small caps. I'm not showing you NASDAQ All-Stars, but I'm showing you large cap leaders because this one, again, is a little different. This is the S&P 500. So we went from the opposite of small caps, S&P 500. So these, you know, these aren't the most exciting companies, but they're the gold standard. You don't have to worry about these things going out of business. And we have two filters on this. We have a momentum filter, and then we have our TSI, which is trend strength filter. So there's no fundamentals in here, just two momentum filters, and there's no leverage in here. And so this thing really outperforms or outperformed when we had a strong trending market, as you can see. And then when the market got hit hard, these things held up. The Magnificent Seven, well, we have a very different view of Magnificent Seven here. So it held up nicely. It's not up thousands of percent since 2017, but you can see where the SPY is. I mean, the SPY is basically flat to down from the beginning of 2022, and the large cap leaders has done great over that period. All right, so again, this isn't one that's going to shoot for the moon, but if your personality is, hey, I want to outperform the market, I want to be in blue chip stocks, I don't want to have to watch the market all day, then large cap leaders, this would meet your personality, and you're going to be buying momentum. Profit Navigator. All right, so this is again totally different than what we've been talking about. Profit Navigator just trades the SPY. I take that back. We have a version of it that trades SPY and rotates with the TLT. But the thing that's really different about this is it's getting its decisions to buy and sell off market internals data. All right, this is very unusual. Now, as a result of doing this, I literally had a customer complain to me once, why is Profit Navigator buying? The market is going down. Can't you see that? Why don't you wait for the price to go up and start buying? Now, he's talking to someone who likes to follow trends, so he has my sympathy. But we have another product called Alpha Rotation that will not buy if the trend is not intact in price. But Profit Navigator doesn't care necessarily. There's a necessarily, and I'll get to that. Profit Navigator is looking at market internals, things like advanced declines, market volatility, new highs, new lows. That's what I mean by market internals. Now, the nature of market internals is that market internals, by the very definition that we're using, is looking at how the underlying stocks are doing. Are they going up or are they going down? It's not looking at the price of the index. So yes, the market was going down when this customer was rightfully accusing us of buying the market was going down. But what was happening under the surface is that the number of stocks that were going up versus going down, or making new highs versus making new lows, or with volatility, had positive volatility versus negative volatility, that was all improving. Profit Navigator picked up on that. We bought, I don't remember the exact date. We just got out of the position recently and had an amazing run once the market turned around. And after that happened, everybody thought Profit Navigator was genius. Why? Because why were we buying when the market was going down? Now, we're not always going to do that. And the other thing that's different about this product is that it scales into positions. So all of our systems and most traders will buy all at once. They'll get into a full position right away. This doesn't do that. This has 2 potential entries, and then it has 3 scales, meaning we sell, and we do that with all our models. We don't sell all at once unless we're getting out to protect capital. We take our profits in tranches. This is part of the risk management. And so this is very different in that sense, in that we have a signal, a set of criteria that will get us into half the position. And then we have another set of criteria that'll get us into the other half of position. So sometimes we get in relatively close to one another, sometimes we don't. But each one of those has 3 exits. So we're really scaling out and scaling in. It is super professional in terms of how it executes. And for some, maybe a little too much work, a little too complicated, but same thing. We tell you when to get in, when to get out. You know where your stops are, you know where your targets are. And it's a great adjunct to anybody who has a system that is really of the mindset of the market has to be going up, I have to be in a strong trend to be a buyer. All right, now Profit Navigator might buy when you're in a strong trend. It can do that too, but it's going to be based on market internals. So market internals will have to cycle to be slightly negative. And it does pretty well. I mean, here's Profit Navigator in the blue, and here's the SPYs. All right. So, up 450% since 2018. But more importantly, you can see 2020, it didn't go down, it went up. It went down a little bit in 2022, but then bottomed out and started going up in July. So you may remember, and well, actually it bottomed out in, I think, May, but by July, it already didn't make a new low in July like the market did, and it started heading higher. And when the market was near its low in October, this thing was almost already back to its 2022 high. So just a very different track on the market. Good question, Bart. Does large cap leaders provide dividend yields? So you're going to be in the stocks. We don't calculate the dividends you may have received while being in the stocks. It's a great question. The answer is you own the stock because it's not an ETF. So you own the stock if it gets the dividend. I just don't have the data to tell you how much of the dividends you get, and we're not calculating that in our returns, nor is that an objective of it. It's a really good point, though. Well, I shouldn't say that. It could get some complexity. I was going to say maybe we should look at it to make sure we're not selling right before the dividend, but stocks in the short run, I believe, are more efficient. Dividend recapture strategies are not that easy to do. It's not our game. So, and if you're listening, you have no idea what I'm talking about, then don't worry, you're not missing anything. I'm in the weeds. All right. So Profit Navigator, exciting way to look at the market. Totally different. But let me go back there for one quick second. look at that outperformance. It's risk management. Yeah, it's a totally different way to buy a stock, scaling in on the internals, but the way we manage the position is not that different than the way we're managing the position if we buy a sector because it's got a high TSI. I mean, I cannot overemphasize, the title of this thing is Shortcuts. You may not think of a shortcut as being risk management, but I promise you that if you really wrap your head around good risk management, it is a shortcut to success. And if it's not a shortcut, it is the long route to avoiding disaster. In other words, it's a shortcut to disaster if you don't have good risk management. All right, so I think I am going to wrap it up with crypto. If you're wondering when I'm going to stop talking about systems, I could talk a lot about crypto, but with this, the focus of this being, how do you take something as wild as crypto? I mean, up 97,000%, and that's just what we did. You don't do that without having a simple, focused, risk-managed approach to even something as Wild West as crypto. Now, I don't have, these aren't the right descriptions because I jumped right to the charts. So you're going to have to look at these charts, but I need you to listen to me. The crypto quant model does the same thing that the sector model does, that the NASDAQ 100 model does. It takes the select group of cryptos. In this case, we're taking the large cap cryptos. You could, just like we take the large cap NASDAQ 100, we take the large cap crypto coins, take the top 20, rank them by TSI, only trade the top 2, apply our risk management to it, and voila, for lack of a better term, this is how it does. Now, it's not fair for me to overemphasize the returns here because crypto has just been that crazy. So 2017 up 1,700%, Bitcoin was up 1,400%. All right. What we're more proud of is actually 2018. We were down 29%. Bitcoin got wiped out, 74%. All right, down 29%. In fact, look at these drawdowns here on an annual basis. The S&P was down 35% in 3 months in the pandemic crash. All right, so the fact that we're able to manage the risk here is really, in my opinion, the remarkable part. But the upside is clearly exciting too. And overall, we've managed to dramatically outperform Bitcoin by, in part, being a little bit better than it, if not sometimes significantly better when it's up, but absolutely crushing it when it's down, right? And that makes all the difference. So only being down 30% versus 74% makes all the difference, all right? Only being down 20% versus 64%, so important. We have a whole other crypto model that trades the altcoins that isn't up as much as this, but it's in and out in 2 weeks or less. I'm not going to talk about that here, but my point with this is that if you're interested in crypto and you want to do it in a methodical quant-based way, you can. Not only that, you can trade just ETFs, so you don't have to open a crypto wallet. We also have a strategy that only trades MicroStrategy, which is a stock. So you could trade crypto and the moves of crypto based on the movement of a stock, and that thing's been up phenomenally as well. All right, so it's very cool stuff that you can do with systematic trading. All right, so that's automated trading systems, and what I tried to do is show you all the the variety. That those aren't all the systems we have, but it is that encapsulates most of them, and it gives you a good sense of the different avenues you could go. And most importantly to me, like I said, shortcut is risk management and really understanding what you're doing. And you can apply it to small caps, large caps, crypto, sectors, the SPYs, the Qs. What do you want to trade? How volatile do you want it to be? How much time do you want to spend on it? You decide what works for you, and then find the system that fits that. Spend 6 months on it, and you will have that will be the fast track to success in your trading. Even if that particular model doesn't have its best 6 months, if you do that, you will have potentially your best 6 months as measured by growth in your understanding of you as a trader. And I would be willing to bet that the odds are extremely high that if you do that, you will have a strong 6 months on performance as well, because you're putting everything together. All right. Now, the other side of this is discretionary. I couldn't end this presentation without talking about it, because we are very much discretionary traders too. I love discretionary as much as mechanical and as much as AI driven, which I'm not going to talk about that, but that's coming too. So let's talk about discretionary for a second. I have 3 charts, and I know this should really shock anybody who's been to my webinars for any of these. The first chart has to do with market phases, and some of you have probably heard of Mish, our partner. She's on media all the time. She wrote the book Plant Your Money Tree, and she is known for really taking this concept of market phases and making it really easy to trade, really easy to apply to your own trading. How many of you use market phases? I know one of you said earlier, Bart, you said, I think it was you, Bart, said you were using the 50 and 200 and then market phases. Yep, saying, and thanks for the mention of the book. Yeah, and if you are interested in the book, Mish's book, I mean, you can only get it on our site, but we'll give you bonuses of training, and it's $19.95 with free shipping. And if you get it through Rob, he'll actually hook you up with a segment of her course. So definitely at the end of this, if you can go to our site, but if you get it through Rob, this is kind of a secret we've been talking about and haven't started the promotion. He'll give you access to one of the modules in her course as well. So anyway, so Mish focuses on market phases. If you're just getting started from a discretionary point of view, man, focus on market phases, 50, 200-day moving average, and with that, you'll be able to determine the different phases and when you should be long or short, or neutral in any one of these phases. And she has, as a course, a whole course that will tell you starting from how to open an account to how to scan for phase changes. One of her favorite, and I have to say, also one of my favorite places in the stocks trend to look for swing trades in a phase change. So a perfect place to start to just do core principle swing trading with market phases. Then we have 2 sets of what I like to call kind of internally our magic indicators. I don't like to say that from a marketing perspective and give anybody the illusion that we've got a crystal ball. There is no crystal ball, but there are some pretty crazy lines and indicators that will give you insane insight into what the market is likely to do. And so I took this slide out of one of the presentations for what we call triple play. And the idea behind triple play is we focus on the fact that there are some core edges in terms of trends that exist in the market. There's a leadership trend, there's a volume trend, and there is a momentum trend. And we measure each one of those in our own unique way. And this blue line over red line here, which is labeled price performance, is our leadership trend. Essentially, if this blue line is over the red line, this stock is demonstrating leadership within the market, means its trend is stronger than the market's trend, which means it's more likely to do its own thing, regardless of the short-term ebbs and flows of the market. And when you learn how to read this, then you'll learn how to, as I have marked here on the chart with the arrows, learn how to identify when moves across moving averages, the same phase changes that Mish talks about, you can identify when they're more likely to work, right? So there would be one because the blue line here is strong and the trend in volume is strong, blue over red. Remember how I said keep it simple? This is how I designed this. This is how I use this. Blue line over red line is good. Blue line under red line is bad. And of course, there are nuances to it, but if that's all you focused on, and then looked for basic patterns in the trend to enter and exit and have a really good risk management strategy, it doesn't have to be more complicated than that. So you can see these two Magnificent Seven, which, you know, by the way, you may remember the Magnificent Seven were all hated at the end of 2022. And nobody realized they were magnificent until halfway through 2023 when it was too late. But if you had just been focused on what's leading, what's the market telling me, you would have seen that Facebook, even though it had been thrown out like a piece of trash in November, had quickly reversed and was outperforming the market and really strong. And stronger than the market going into the new year, stronger than the market coming out of the new year. And that trend just kept continuing. And eventually everybody thought it was magnificent, right? But if you were looking at what the market was telling you with indicators like this, because you're a discretionary trader, then you could have seen it coming, right? Apple, same thing. So I am taking this right now, this concept. Some of you have heard it, but I didn't pick on the Magnificent Seven back here. What I did is I said in the beginning of 2023, I'm going to teach this course called the Golden Cross, and it was all about bringing attention to the fact that the 50 had crossed over the 200, which for a discretionary trader is just a core bullish alert type of thing. And I said, let's follow this. Now, I see the same thing happening in 2024. It's just not the Golden Cross. It's the same cup and handle type market leadership pattern that's going to happen throughout 2024. So for a discretionary trader, I have this plan. I called it the running of the 2024 running of the bulls. And anybody who's a triple play member, or really a member of any of our discretionary triple play or Real Motion, I'm going to show you in a second, you're going to hear me talking about it every single Wednesday in our live training, because that has to do with keep it simple, keep it consistent, keep it focused. And I'm going to do that with that particular concept or that trade to reinforce what I'm saying right here. The shortcut to being a good discretionary trader is to have a strategy, pick that strategy, focus on that strategy, have it have an edge, and just learn it really well. I told you earlier that I am really having a lot of fun trading, shorting 0 DTE options in the SPYs, little in the Qs. For some reason, I just really like the SPYs. Well, here's a little trick. Here's a little secret. Here's something consistent with what I've been saying this whole webinar, and we're just about done. This is a chart of the 50 and the 200-day moving average of real motion. This bottom green two lines here is the most basic version of real motion. And when the moving averages in real motion, which is a momentum indicator, are doing the opposite of what they're doing in the price action, then the price action is probably going to follow the momentum. And when it does, it's going to have a good trend break that you can trade. So if I frame that slightly differently, if real motion has the divergence and then the Qs break their 200, they're probably toast. All right. If the 200, if price rallies back up to the 200 and starts to roll over, and you have a negative real motion reading down here, it's probably going to roll over pretty hard. That's a pattern. It's this same pattern that I use on a 5-minute chart in the SPYs to determine when to sell these options and occasionally when to buy them, and always when to look for a reversal on an intraday basis in the SPYs. I did a huge thing I meant it to be 5 minutes. When it was done, I looked at it, it was 35-minute segment in live training, all about how you can find these divergences in a 5-minute chart to tell you when to enter swing trades in stocks, and specifically in the SPYs. We had one today. It was bullish today. For the first time in 3 days, it turned bullish, and we had, if you go look at the SPYs, intraday trade or intraday trading, they came back up through the opening range in the middle of the day with the same look as this right here, except it was on a 5-minute chart and it ran like crazy. For you zero DTE options people, the other trade that I've been playing with is then buying the slightly out of the money call today. That call went from 20 cents to $1.37 in the last 2 hours, 3 hours of the day. It's a little wild, you know. I wouldn't try and put retirement money in it, but it's fun. And the cool part is it's the same exact signal that I'm using with the 50 and the 200 to determine the trend change for the bear market of 2022 starting to the bull market of 2023 beginning. When you are a discretionary trader and you understand how markets work with a focus like this, that's a shortcut to figuring out how markets really work. All right, please find a way that, look, if it's not real motion, find your way. But if you want to master momentum, join us for real motion. If you want to master leadership, if you're an IBD person, you're going to love the leadership and the volume trend, then that's triple play. All right. Clearly, I could talk about this all night long. I try to limit the number of slides so I don't. Let's wrap it up. What's it going to take to succeed? You need risk management. You need discipline. You really should have a proven strategy, right? Now, how are you going to make that all happen? First question I asked you in this presentation, what fits your personality and your lifestyle? If you're not sure, call us. I'm going to give you Rob's number in just a minute. He's a trader. He knows all our systems. He knows exactly what I'm saying. He can help you find that fit. Keep it simple. We're going to force that. Like, if you hang with us, we are going to keep it simple for you. We can't force you to focus, but our guarantee on our systems is 6 months. There's a reason for that. All right. So we're doing our best to force you to focus on something for 6 months. It's not just me. All right. I love this quote from Bruce Lee. Fear not the man who has practiced 10,000 kicks once, but I fear the man who has practiced one kick 1,000 times. I couldn't have said it better myself. So I'm going to end it with this. I said in the beginning, we're here to help. I don't have a sales pitch for you on this one. If anything that I've said here makes sense and you want to explore how it can help you in your trading, just give us a call. Rob is not a high pressure guy. Just go to marketgauge.com/call. Here's his personal/business number, but Again, he lives on the East Coast. He will answer the phone potentially at midnight if you call it. So don't call him at midnight, because every Monday we have a sales meeting, and every once in a while he's like, "You're never gonna believe this. Somebody called me at like 1 in the morning. Like, what are they thinking?" I'm like, "Rob, I don't know. Maybe I should be more vocal about telling him you're on the East Coast." You could send him a text. All right. And of course, you can reach us at our website, markygage.com. If you become a member of any of our services, almost any, I will invite you to have a call with me. Some people tell me it's not really an invitation, it's an insistence. And I will pester you for like 3 or 4 emails. Like, now's your chance. Now's your chance. I encourage you to do it. We want to help you get off to the right foot. So that's all I've got. If you've got any questions, please throw them in the questions box. And so Bart's question on the last, I think it's the last slide. Magenta line is the 10-day moving average. So green is 200, blue is 50 on all our charts. Magenta is the 10. My phrase is I live on the 10. I live around the 10 because it's a way to get into long-term trades with a short-term indicator. It's a way to find short-term moves from a swing trade perspective. But what you'll learn, Bart, you know this because you've been around us, it's not, the magic isn't in the number you pick for your moving average. The magic is in how you manage your trade around it. That's what I've been saying the whole time. You know what I should have thrown into this as a bonus is we just did a session on calendar ranges. You're not going to find that anywhere else. It is unique, and Rob's great at putting together packages. If you want more than one to create a blend, if you want to balance, if you want to do both, discretionary. So he will do packages, and this would be a great time to get the calendar range thrown in with that. It's really appropriate to January, although it works all year long. All right. Any other questions? And first of all, thank you for all the participation right up front. Hopefully you can see, I can see that everybody has stuck around for the whole thing. And so hopefully you can see why I was so insistent to really make you think about what you would like from your trading, and now focus on it. And if we can help you do that, you know how to get us. Thank you so much. Jack, thank you for the feedback. So Jack's feedback was calendar range number 1 was great. Number 2 is crap, but tonight this was absolutely gold. All right, so if we're not transparent, I don't know what is. And you know what, Jack, I know exactly where you're coming from, because I got done with calendar ranges number 2, and I was just like, that isn't what I wanted. So I agree with you, and I apologize for that. And we'll do better. We'll do better. But the challenge with 2 was I told you, I gave you everything you needed to know in number 1, and I wanted to reinforce it with number 2, and I tried to do it with examples and quickly. And I think it's a valid critique. And maybe I have a solution for that. But thank you for the feedback, because I never know. Sometimes I come home from webinars and I'm like, oh man, that was terrible. And then the next day we'll talk about it, and people say, no, I thought that was good. And plenty of times the opposite is true. So Thanks for the feedback. And even better, I think you guys can all see this if I post it. And I know, pretty sure Jack's not going to mind. So I think you guys can see what I just saw from Jack. He didn't just say calendar ranges 1 was great and number 2 was crap. He put it in all caps. So I'm laughing, but look, we like the feedback, and he was right, and it will get better. Well, Jack, since I have your attention, are you using the scanner that's in there, at least for January, for to see the different sectors that are going to be now breaking out and the sectors that are ahead on their 1 month, because that has been pretty on top of what's been happening. Fortunately or unfortunately, this was a year where the market started one way, moved the next, and not only that, it moved the next, and now we're kind of in a holding pattern because the big range was just set up. So we didn't have the easy Januaries where it's just like first day gets set, then it takes off, and it just keeps going, and it's in the direction that works for the overall market. And those are the layup years. And then you get the big range, you reassess. So we are set up nicely, I believe, for if this market breaks out higher, the calendar range breakouts are going to set up charts that are easy to read with good stops, and that'll be the gold. The other gold that will exist in the value of the whole thing will be the unfortunate scenario of if the market sells off. And if the market sells off at this point, based on what it's done, and breaks that big calendar range low, that will be a level that I would want everybody who's part of our community to know that that's a really significant level to break. Don't mess around with that. So that's the value, and we'll work on that. All right. With that, I'm gonna call it a wrap, and Jack, yeah, I'm gonna say this again. Jack, do you have the indicators? Are you using the indicators on either stock charts or TradeStation or Thinkorswim? Thanks, Brian. Yeah, I would be curious. This is a new session. I went longer than I thought I would go. Surprise, surprise. I am looking at the time. So any feedback on this session, I absolutely would appreciate. Although I am gonna close it down in just a second. With that, I am going to call it a wrap again. Thank you very much. Have a great evening, everyone, and I encourage you all to, well, not all, anybody who wants to take this conversation to the next step, to give Rob a call or book a call with him, and have a great rest of your night, morning, wherever you are, or week. Bye for now.